Hi, morning clients. Welcome to this week's weekly webinar. The home here I cover REITs, and today our featured stock of the week will be First REIT. So before I go on to touch on the fundamentals, here's a stock price chart of First REIT over the past 2 years. So those of you who are into TA, you will be able to see that this is the kind of charts that you love to see. So First REIT has been on a very nice uptrend since the start of last year. And hopefully we can see the trend going on. So what is First REIT exactly and why do we like it? First REIT is primarily a healthcare REIT. They have a portfolio of 16 hospitals and nursing homes, and primarily their properties are mostly in Indonesia. What we like about First REIT is that First REIT and its sponsor, Lippo Karawaci, they're ramping up their presence and their network of hospitals in Indonesia at the most opportune time. So why do we think that this is a good time to ramp up your presence? President Jokowi last year introduced this healthcare insurance, which is aimed to cover all Indonesians by 2019. So prior to this insurance cover that the president introduced, only about the poorest 80 million out of all the citizens were covered by healthcare insurance. So this new healthcare insurance is expected to boost healthcare demand. Secondly, we like First REIT for the fact that it can leverage off the sponsor's synergistic business and the fact that there is an experienced hospital operator spearheading Lippo's expansion plans in the healthcare sector. So the hospital operator appointed to operate all First REIT's hospitals and Lippo's hospitals is Siloam Hospitals Group. And Siloam is actually the largest private hospital operator in Indonesia at the moment. Lastly, we like First REIT because all of First REIT's properties are on master leases, and this provides stability for the portfolio. Forex risks are also mitigated because the Indonesian hospitals' rentals are in Sing dollars. Okay, next we go on to, we have talked about First REIT, we have talked about Lippo Karawaci, and we have talked about Siloam Hospitals. I'll go on to talk about what is the relationship between the three of them and the corporate structure involving the three of them. So you can see over here First REIT, about 1/3 of First REIT is owned by Lippo Karawaci, and Lippo Karawaci also owns Siloam Hospitals. So in this whole equation, Lippo is the property developer, and they develop and build hospitals, and once the hospitals stabilize and mature, they will sell the hospitals to First REIT and lease them back on a master lease. So in return for the favor of capital recycling, Lippo gives First REITs the rental in Sing dollars and take on the forex risk themselves. And Siloam will be the hospital operator who will then lease the properties from Lippo again. But from First REIT's point of view, their master lessee will be Lippo Karawaci. So in order for sustained pipeline of good quality hospital properties for First REIT, which is the critical factor for First REIT's success, we think that LPKR's expansion plan has to be successful. And for this to be successful, two factors has to be in place in the market. Firstly, there has to be ample capacity in the healthcare sector to absorb the increased supply of beds. And secondly, Siloam's operating model has to be sustainable and smooth. So some of the key advantages for First REIT would be, First REIT is able to leverage off the synergistic business of the property development business of Lippo, so that Lippo will be able to build hospitals in areas where there's sufficient catchment crowd, in areas where there are residential areas, there are retail malls and hotels around. And at this moment where healthcare demand is expected to surge, we think that Siloam has this first mover advantage in aggressively scaling up the hospital network. Because at this time when you're doing this actually increases your brand visibility and brand awareness. So the next point we are going to touch on is the huge capacity in Indonesia to absorb the increased supply of beds. As mentioned earlier on, the healthcare insurance that the Jokowi government is going to introduce is expected to result in a surge in healthcare demand. So for private hospitals in Indonesia, registration onto this plan is optional. But for all of First REIT's hospitals, they are actually registered onto this plan. So we can expect to see healthcare demand, the increase in healthcare demand filtering through from the public hospitals right through to private hospitals who are registered onto the plan. And as we can see, for a few months after the healthcare insurance was introduced, we saw a lot of media reports stating that healthcare hospitals in Indonesia actually saw a doubling or a tripling in the healthcare demand, and we see reports like queues forming at the public hospitals, patients getting frustrated with the queues, and so on and so forth. So from there, we can actually tell that Indonesia is indeed undersupplied in beds. And the next chart we are going to show you will confirm the figures. As you can see, from the bed to population ratio, Indonesia versus the developed worlds, Indonesia has a ratio of only 6 beds per 10,000 population as compared to developed worlds like US, which has 30. So you might say, okay, maybe it's not fair to compare Indonesia with US because they have a much bigger GDP, and Indonesia, at the end of the day, they have a much younger population. So you might say, okay, maybe the population is not as old, so they would not need as much hospital beds. So the next thing we do is to compare Indonesia with Malaysia and Vietnam. So if you can look at these 3 countries, they actually have very similar population median ages, and the variance between their GDP is not that far as well. But even comparing these 3 countries, you can see that Indonesia's bed population ratio is actually lagging the other 2 countries as well. Next, we're going to talk about the second important factor that we think will matter in LPKR's expansion plan. That is the operating model of Siloam Hospital Group. We did a site visit to 2 of Siloam's hospitals under First REIT last month, and we came back convinced and confident that Siloam will be the operator which will be able to successfully spearhead LPKR's expansion plan because of certain factors, attractive factors of Siloam Group. So the operating model of Siloam Group is that they have a model similar to Raffles hospitals in that doctors are free to use the clinical space in the hospitals. So whatever patients they bring in, they will earn all the consultation fee, they will share the consultation fee with the hospital. And when the patients actually use the facilities in the hospitals like the labs or the scanning facilities or the wards, then that is where Siloam will earn revenue from. So Siloam's model is that they allow the doctors to earn a bigger cut of their consultation fee. So basically doctors take back 100% of what they earn, minus just a small 5% administrative fee. And in Indonesia, I think they have the same problem as us, which is the problem of having not enough doctors in the hospitals. You can tell from the chart here that Indonesia's physicians per 10,000 population is severely lacking the other countries. So what Siloam is doing to counter this is that they have a collaboration with this UPH. This UPH is Indonesia's leading private university, which would allow them to provide Siloam with a pipeline of doctors. Other than that, Siloam also has state-of-the-art medical equipment, modern facilities, and brand prominence and scale. Siloam has also won numerous awards over the years, which adds to the brand reputation. Okay, I'm going to move on to part 3, the Master Lessee's financial health. But I hope everyone is okay there and everyone is hearing me loud and clear. So First REIT derives 88% of their rental income from the sponsor, LPKR. So LPKR, a little background about them. They're the largest property developer listed in Jakarta by revenue and by total assets. So LPKR's gearing ratios, which is the specifically we looked at debt equity ratio, has been consistent about 0.4 to 0.6 for the past 5 years. This actually is pretty consistent with the average Singapore developers over the past 2 years. And liquidity ratios, we have noticed that has also improved over the past 4 years. For LPKR, healthcare is now one of the main business, and LPKR derives 30 to 40% of their revenue from healthcare. We think that healthcare is able to help LPKR derive cash flow, which is independent of the volatile property cycle. So we expect to see LPKR continue to place emphasis on this sector. A little about the company analysis. So we talked about the master leases for First REIT providing stability. As you can see from the expiry dates of all the properties, the nearest one is actually in August 2021. And all their leases have this extension option where the master lessees can actually have the option to extend for another 10 years for the Singapore nursing homes and the Korean hospital, or 15 years additional for all the Indonesian hospitals. Apart from that, the master leases for First REIT actually provide built-in escalations as well. For the Singapore nursing homes, the escalations are 2% annually, and the same goes for the Korean hospital. And for the Indonesian hospital, the increments are actually pegged to the Singapore CPI, but subject to a floor of 0% and a cap of 2%. Next, we talk about forex risk and interest rate risk. So forex risk, as we mentioned before, because the Indonesian rentals are in Sing dollars, so there's very little forex risk there. And because the Indonesian properties are getting income and cash flows in Sing dollars, so when they're appraised and when they're valued at the end of every year, the valuers will appraise the properties in Sing dollar terms as well. So in that sense, your asset values will not be subject to forex risk as well. This actually gives you a chance to ride on the healthcare sector in Indonesia without having to suffer forex exposures. Next, interest rate risk. For First REIT, 95% of their debt are already on fixed interest rate basis, and there's no refinancing need until 2017. We look at the peer comparison for First REIT. So as you can see, First REIT and Parkway Life REIT, which is the two most common healthcare REIT people talk about in Singapore, you see that P Life REIT actually has a lower yield, and we think this is because the master leases for P Life REIT actually are subject to escalations which are pegged to Singapore CPI as well, similar to First REIT. But the thing about P Life's escalation is that they are Singapore CPI plus 1%. So they are subject to a floor of 1%, and there's no cap basically. So when your CPI is high, let's say like in 2010 or 2011, when our CPI went up to 4 or 5%, so that is when P Life will get a very huge escalation in their rentals. So you get a 4% CPI plus 1%, that's 5%. But for First REIT, they're actually capped at 2%. So the escalation will be capped at 2% even if CPI goes up to 5%. So because of that, because of the more favorable escalation terms, we think that is why P Life REIT is trading at a lower yield. But note that when CPI is low, like in this year, for example, the advantage that P Life has over First REIT will not be as significant, because when the CPI is low, P Life will be subject to a base of 1%, and First REIT will have 2x the CPI percentage for the year. So the difference between the two will not be that significant. As for Religare Health Trust, you see that the yield is the premium in yield for Religare over First REIT is pretty significant. It's a cool about 1% premium, and the PB is lower as well. But one thing to note is that Religare derives their revenues from base rents and from service rents. And for Religare, their service rents is actually a pretty much higher percentage out of the total revenue as compared to First REIT and Parkway Life REIT, which derives most of their revenue from rentals. So in that sense, Religare will have their revenues slightly more volatile than the other two. So in that sense, if you're buying REIT from the point of view as like a fixed income and stability point of view, that model actually presents slightly more risk for investors. Key risks would include, as mentioned before, LPKR's expansion plans fail to gain traction. This could be because of a variety of reasons: poor public perception of the medical service, or the failure to attract quality doctors would be a few of these reasons. And if the expansion plan fails, this will choke off the pipeline of acquisition targets for First REIT. And the next one is LPKR's financial health runs into problems because First REIT has 88% of the rental income from LPKR. So lastly, we initiate First REIT with an accumulate rating. Our target price is 155. Last close on Friday was 145. So the upside from here, including dividends, will be around 14%. In summary, we like First REIT because of their affiliation with LPKR, being the largest property developer in Indonesia by revenue and buyer assets, and its affiliation with the Siloam Hospital Groups, being the biggest private hospital operator to drive the expansion plans. So on a side note, talking about Siloam being the largest private hospital operator, we like to point out to you that the second largest operator in Indonesia, which is the Mitra Group, they are not having an expansion plan as aggressive as Siloam. So currently they have about 11 hospitals and they're projecting another 7 by 2017 versus Siloam's 20 currently and a projected of 40 to 50 in 2017. So with no other competitors nearing an expansion scale like Siloam's, we think that at this juncture, Lippo and Siloam has this first mover advantage in ramping up their network of hospitals in a country where healthcare demand is expected to surge. Okay, lastly, we go on to talk about the week ahead. Earnings seasons continue next week, with the biggest coming from Wilmar and Sembcorp on Thursday. Apart from that, we also have factory orders and ISM non-manufacturing data from the US, the important employment data from the US on Friday, and Indonesian GDP as well. Okay, that's all for today. Any questions? There's a question about whether the 5% admin fee paid by the doctors, whether is it sufficient to sustain the operations of the hospital or not. So as mentioned earlier on, this revenue consultation, we are talking about consultation fees here. So consultation fees, the hospital and the doctors actually have this consultation fee sharing model, whereby the doctors use the clinical space for free, and then the different hospitals will have different agreements with the doctors to share the consultation fee. But for Siloam, they actually agree to pay out most of the fees to doctors and retain the 5% admin fee, which is more generous than the competitors. As to whether this 5% fee is sufficient to sustain the operation of the hospital, the Siloam Group actually does not just earn from this consultation fee. When the patients come in as outpatients and they use the hospital's facilities like scanning labs, or when they go from outpatient or from A&E to being warded and use the wards, that is where Siloam earns the bulk of the revenue from. So Silom does not count on consultation fees at all. They count on fees that is derived from the usage of the facilities and their wards. Hi, there's a question on the exchange rate risk. So the question is why is exchange rate risk not a risk, because revenues from the patients are in rupiah. So the relationship between the three, okay, let me go back to the chart. The relationship between these three entities, Lippo Karawaci, First REIT, and Siloam Hospitals, is that Lippo is the developer of all the hospitals. So when the hospitals mature and stabilize, Lippo will pass them on and sell them to First REIT to recycle capital, as all developers need to, and they will lease back all the properties from First REIT on master leases. So from First REIT's point of view, what they are concerned is that all their properties are all on master leases with Lippo Karawaci. So rents to First REIT will be paid from Lippo Karawaci to First REIT in Sing dollar terms. As for the revenue will go to Siloam Hospitals, which is the appointed operator of the hospitals. And Siloam will in turn pay rents to Lippo Karawaci. So it is a bit confusing there, but from First REIT's point of view, we do not care whether the revenues from patients are in rupiah or not in rupiah, because for First REIT, all the rentals for the properties are from Lippo Karawaci and they're all in Sing dollars. So Siloam is the one, so Lippo leases from First REIT and then sublease them to Siloam. And Siloam will then pay Lippo the rents. There is another question on whether UPH is the only source of their doctors. So UPH cannot be the only source of their doctors, because it wouldn't be sufficient at the rate Lippo and First REIT and Siloam is expanding. So Lippo is just one of the sources. As for the other ways, okay, as we understand from management during our site visit, doctors in Indonesia, they usually have a dual practice, in that they do not spend all their time in one hospital, but instead they apportion their time in a day. Let's say maybe they'll spend 4 hours at Siloam Hospital, and then the other the other the other hours they will spend at competitor hospitals. So what Siloam is trying to do is that they're trying to offer better rates and offer better facilities for the doctors to entice these doctors to come over from competitor hospitals instead. So not just from UPH as one source, even within Indonesia, as competition between the various private hospital operators, Siloam has certain distinct advantages in attracting doctors over from competitors. And because Siloam operate hospitals in cities as well, so the shortage of doctors would not be as acute in cities, because most doctors would want to gravitate towards cities to work. There is another question on debt-income ratio. I don't quite understand the meaning of what you mean by that debt-income ratio. But if you're talking about gearing and debt-asset ratios, the gearing ratio currently for first REIT is around 33%. Hi, there's a question on Religare. So as touched on just now, indeed, you can see that Religare has a better yield, has lower gearing. And currently we do not have a coverage on Religare, so we do not have a TP on it. But I do think that Religare deserves a look into as well. But just on the surface, looking at it, Religare, as we mentioned just now, they actually derive a good portion of their revenue, total revenue from service fee. So they have two components. One is the base rent. The second component is the service fee. So if you look at First REIT and P Life REIT, bulk of their revenue will be coming from the base rent. But for Religare, they have a good 20 to 25% of their revenue coming from service fee. So that portion will be pretty volatile in that if your hospital's occupancy drops, you see that portion of the service fee actually will affect the top line growth. So you see like your top line will be pretty volatile as compared to First REIT and P Life REIT. Because for First REIT and P Life REIT, hospital occupancy would not be top of their concern because they're getting master leases on the hospitals. So from a REIT's point of view, if you're buying REITs for stabilized income, that the model of Religare might pose slightly higher risk because of the more volatile income. So that might explain the slightly higher yield that Medicare is giving. But from a business point of view, if you are a believer in the Indian health story, then it might not be that. It might be worth a look. But currently, we do not have coverage on Medicare as yet. So. There's a question on what is service fee. Service fee is actually revenues derived by the hospital. Alright, if there are no further questions, that's the end of our webinar today. Thank you.